What if I told you that every time your salary slips by a few rupees, it's building a safety net for your retirement without you doing anything extra? In this video, we're going to unlock everything about EPFO, what it is, how it works, who's covered, and why so many people depend on it. By the end, you'll see not only how EPFO helps you today, but how it secures your tomorrow. And yes, there are also some problems people face. Let's dive in. EPFO stands for Employees Provident Fund Organisation. It's a government agency in India under the Ministry of Labour and Employment. Its job: manage three big schemes that protect workers for old age, unexpected death, or periods without work. The three schemes are Employees Provident Fund, EPF. It's like a savings account you build over your working life. Both you and your employer chip in every month. Employees Pension Scheme, EPS, gives you a regular pension after you retire, if you meet certain years of service, instead of just a lump sum. Employees Deposit Linked Insurance, EDLI. That's insurance in case something happens to you while you're working, so your family gets a benefit. Here are what EPFO actually does. 1. Collects contributions from employees and employers every month. 2. Keeps individual accounts so you know how much you and your employer have contributed, plus what interest it's earned. 3. Invests the pooled money safely to earn interest. That interest helps grow your total savings. 4. Settles claims, meaning when you retire, resign, change jobs, or in cases of emergency or death, EPFO processes withdrawals, pension payments, insurance payouts. 5. Enforces the law, ensures employers follow the rules, penalizes non-compliance. 6. Maintains records and updates, tracking membership, transfers when you switch jobs, making sure you get notified for things like credits to your account. Let's go through how EPFO helps in real life, with everyday examples. 1. Retirement savings example. Suppose Meera starts working at age 25. Every month she contributes 12% of her basic salary, and her employer contributes too. Over 30 years plus interest that builds a strong corpus. When she retires at 58, she gets that big sum to live off or use as she needs. 2. Pension income via EPS example. Raj works for 12 years in a company. Under EPS, after he turns 58, he starts getting a monthly pension from the government scheme. Not a huge amount, but enough to help with monthly expenses. 3. Insurance, death benefit, EDLI. Example: Anita is working and paying into EPFO. If something happens to her while she's employed, her family will get a lump sum benefit under EDLI, so they aren't left totally insecure financially. 4. Withdrawals and advances for life events. Example: Suppose Ravi needs money for his daughter's wedding or for his child's education. EPFO allows partial withdrawals under certain conditions, or if someone is unemployed for a while, there are rules for withdrawing portions. 5. Job switching, portability example. Neha works in Company A, has EPF number there. She then moves to Company B. Because of the Universal Account Number, UAN, Neha can transfer her EPF balance between employers without losing track or needing a messy paper trail. 6. Tax benefits example. Every year, part of what Meera contributes to EPF counts as a deduction under Section 80C of the Income Tax Act. Also, if she withdraws after 5 years of continuous service, that withdrawal is typically tax-free. Who is covered? Salaried employees in the organized sector, companies, factories, shops, etc., are covered if the employer is registered with EPFO. It's mandatory where establishments have 20 or more employees. Employees whose basic salary plus dearness allowance is up to Rs 15,000 a month are automatically covered. If you earn more than that, there is an option under certain rules to join voluntarily. International workers, foreign nationals working in India, or Indian workers working abroad under certain agreements may appear under special provisions if India has social security agreements with those countries. Benefits of EPFO builds a forced savings habit. You save without thinking. Guaranteed interest. The government fixes an interest rate annually so your money grows. Pension plus insurance safety net for old age or for family in case of death. Liquidity for emergencies. Can withdraw for health, education, home purchase, etc. Under certain rules. Portability. Switching jobs doesn't mean switching PF accounts manually. UAN helps. Tax savings under Indian tax law, transparency and digital tools. You can check balance, get passbooks, track claims, etc. Challenges and criticisms. The interest rate may fluctuate, sometimes be lower than what people might get via private investments. Early withdrawal reduces the final retirement corpus. Taking out money early means less compounding. Coverage limitations. Large sections of informal sector workers aren't covered. Not everyone is in a job that qualifies under EPF. Some employers delay or default in depositing the employer's share or fail to update records. The process, though improving, can still be slow or bureaucratic. Forms, attestation, etc., especially in older schemes. For people who switch jobs often, paperwork or delays in transfer can still cause hassles. So, EPFO is like your financial safety net. A government system that helps salaried workers save for retirement, get pension, insurance, and some help in emergencies. You and your employer both chip in. Your money earns interest. You can use it later when you need it the most. It has huge benefits. Tax savings, peace of mind, but it's not perfect. Some people fall through gaps, some processes are slow, and returns depend on government policies. If you found this useful, hit like and subscribe so you don't miss videos that make your money life simpler.